All right. How does commercial financing actually work? My name is Desmond Soon. I'm the co-founder of Commercial Financing Mastery. Today, we are joined with the founder of Commercial Financing Mastery, Sua Truong, who has well over 30 years of experience, has mentored well over 300 very successful commercial financing experts all over North America. Welcome to the show, Sua. In this series, what are we going to be covering today?
Great to be here. Well, we cover a lot of FAQ, right? Frequently asked questions.
Correct.
And you feel free to ask me what you want to ask so that the followers and the attendees who are watching us can learn from us today.
Right. So this is where it gets interactive. If you have a question and you would like us to cover it in a future video, you can always type it in the questions below in the comments. We do read every single one of them, and then we can create a video for you. There will be at the end of the video, stick on all the way to the end, we'll give you an invitation where you have an opportunity to even join us in a live workshop and be able to ask your questions live to Sua if you have any questions that are not covered in today's video. So let's get started. The first question that we get all the time, and this is probably one of the most common questions in the commercial financing space, is what is the difference between residential mortgage and a commercial mortgage? And this applies for North America, Canada, and the US.
Yeah, I mean, the simplest way to think about it is a residential mortgage is with a house, condo, someplace you live in. Commercial mortgage is anything else. Everything else. Okay. Everything else. So include investment property, including residential property that you hold for investment.
Yep. What else?
So business loans, anything to do with commercial plaza, commercial real estate.
Yep.
And not just because they are commercial. I mean, I've done where residential, like Airbnb, for example,
right,
or somebody's converted a house into some kind of business, business front. I've done even medical offices that are in a house, but they're zoned commercial.
Right. So it's
on the outside,
it's a mix.
Yeah, on the outside, it looks like a house.
Yeah.
Yeah. The zoning is messed up, in other words.
Okay. So well, then we're going to go deeper into these questions here. So naturally,
next time.
Just off the top of your head, okay. This is something that I learned from you going through your mentorship as well too, was, residential, there's not much variation, right?
It's cookie cutter. It's cookie cutter, basically.
But in contrast, okay, just approximately, I don't know if you have enough fingers and toes to count with, approximately how many types of variety of commercial financing deals are there? If you were to guess at it, or just from your knowledge, how many would you say there are, that are the most well-known commercial financing deals?
Oh, industry type, there's like 5 well-known industry types.
Yep.
And then there's probably another half a dozen. No, there's probably another dozen more beyond that.
Categories, right? Another dozen categories. And in those categories, it can go even deeper and more, right?
That's right.
So in a future video, we'll probably cover those ones. We'll go deeper. If you want to know more about that, stick on all the way to the end. We'll show you how to find out more about that. Question number 2. What types of properties qualify for commercial financing?
I think I gave that away in the first one.
Yeah. Okay.
All types of property. So all types of property can qualify against commercial finance as long as there is a commercial component or a business component to it.
Okay.
That's the key word. But I have to extrapolate. Right? I think it's going to be a long answer for this one.
Well, okay. So let me play devil's advocate. I'll be the student here, and so I'm an investor, and I'm a real estate investor, and I want to get a single family home. Does that for investment property, does that qualify for commercial financing?
Yes.
It does. Okay.
It does. Yeah.
Even if it's a single door?
Yes. Yep. I've done it before. A fourplex or duplex even.
Yep.
Right. It was purchased by a corporation because they have a lot of money inside the corporation. They don't want to take it out as salary.
Yeah.
Because when you take it out as a salary, you take a $250,000 salary, you get dinged by how much? That's like 50% tax.
Yeah, tax, yeah.
Right. But inside a corporation, they're not taxable. So they can use 100% of that money towards the down payment instead.
So if that is actually the property is actually in the holding company, or it's held within the company, the corporation,
that's correct.
It could be that. Yeah. Wow, that's interesting. Okay, so that's going to open up, as you know, I'm connected to some CPAs, and we'll talk about that. More questions.
Yeah.
By the way, so I think the wind blew your computer a bit, so your screen just went down a bit. There you go.
I saw that.
All right. Okay. So yeah, it's very windy. You're in Ho Chi Minh City right now, and you're working your project, right? Question number 3. What does a lender actually look at when they evaluate a commercial deal? What is important to a lender when they're evaluating a commercial deal?
Well, a commercial deal is basically solely relying on the property itself or the business itself. So it's looking at the number of revenue that comes from the business or the revenue that comes from the property itself. Right.
Okay. Can you give an
Nothing
example?
to do with the person.
Can you give an example of, like, say, the revenue that comes from the property itself?
Yeah, we call it the rent rolls. Basically, if whoever's a tenant, the tenants
Yep.
are in there, they usually pay for everything, property tax and all that stuff.
Yeah.
So we usually typically look at the not just the gross income, but what is the net income, the NOI we call it, net operating income from that property, right?
Okay.
Because some places like mixed use property, for example, the property tax is not paid by the residential people upstairs usually.
Yeah.
Okay? It's only paid by the commercial component. So the commercial tenants usually pay the property tax. So they have to figure out a quick calculation to normalize how much the total rent is and figure out what the gross versus the net operating income for that whole entire plaza or the whole entire unit that's the building itself, right?
Okay. And I guess the next question would be, like, what if it's like equipment, or if it's like construction or something, like how do you evaluate, how does the lender evaluate for that?
So equipment is different because equipment is more about future revenue because you don't have the equipment to make that income.
Right.
Like somebody buying a tractor, for example, right? A tractor is equipment.
Yep.
They need that for the business to make money.
Yep.
So you need a CPA. You definitely need a team to come up with all these kind of numbers. Is a projected income. In the residential side, we used to call that stated income.
Right.
So it's a future income that they don't currently have. All right.
Yeah.
So
like you'll need a CPA to produce like a notice to reader.
Definitely.
Right.
Yes.
Okay.
Yeah. Financial statements required. Yeah.
Right. Okay. And okay, so let's move on to the next question here. Right. This is, again, rapid fire here. If you're watching this video and you got some questions, put in the comments below.
Yeah, you want more detail? Just put in the comments below. We'll get back to this. We always answer all these comments, all these questions.
Yeah.
Right?
In fact,
Inspire us. Make the next video.
A question for the audience watching this is, how are you doing your calculations? What do you do when a commercial file lands on your desk or you're asked to handle it? We'd like to hear your answers. Okay, moving on to question number 4. So, what is DSCR? I hear DCR, DSCR, and why does it matter more than personal income for commercial?
Well, DSCR or DCR stands for debt service coverage ratio.
Yep.
In Canada, we dropped the S. We call it debt coverage ratio. In the US, they have debt service coverage ratio, which is same thing, same bloody thing, same calculation, same digit actually, same 1.2, 1.25. It's basically a number to qualify, similar to what the residential side in Canada we have TDS, GDS. In the US, it's like debt to income ratio, DTI. It's a similar way, but calculated on the commercial side. And commercial, there's other numbers involved to come up with that number, right?
Could you go into a little bit more depth? Right now, I know you have some calculators to give away.
I have to disclose all these acronym. So in the commercial side, how to come up with DSCR is you figure out how much the total amount of the purchase is, or the total amount of loan is, divided by the amount of debt that you service, basically, right?
Right.
And that has to come to within a range of like 1.2, 1.25. Right?
Okay.
It's a ratio, basically. It's a ratio. Whereas residential is a TDS, GDS, a DTI is like 44, 50, whatever. 50 is too high. Like anything below 40 is good.
TDS is like 39 and stuff, right?
So
now when you like for residential, for Canadian mortgage brokers, right? Like when calculating TDS, GDS, there's certain things that are added into it, certain things that are not added into it. For commercial side, are there certain things that are added to it? Or
commercial side, we can remove a lot of the stuff. We can add back, right?
Okay.
Like a lot of the financial statement that you see on commercial, like amortization, interest payment, depreciation is a big one. We add those back as income. Right?
Really?
Residential, you can't do that. Like on residential side, you cannot do that unless there's a certain bank and lender that uses the corporate NOI, which is rare, but on the commercial side, we can do wonderful stuff. Even if you only have 50% ownership, we can add that information back. On the residential side, it's much difficult to add anything back. It's a lot of arguing with the underwriter, right? Whereas commercial is just common sense.
Yeah.
Right.
And who sets the rules for this? Like, like it just seems so vague. It's like, you go to a different lender, some add it in, some add it back. Like
you know what though? But here's the thing, Desmond.
Mm-hmm.
In residential, that's true, but
Yep.
in commercial, that is false. Because in commercial, every lender uses depreciation add back, amortization add back, interest payment add back. Heck, even the the taxes owed to the government, you can add that back. So you can't do that on residential. It's like, hey, I pay the CRA, I pay the IRS. Can I add that back? No, you can't.
Yeah. So, and before we get to question number 5, so, how did you learn all these things? Just if you could just, like, how does one person learn
like
all these rules about commercial financing? Like in Canada, you can go sit for your residential mortgage broker. In the US,
yeah, they don't teach this. They don't teach this at the same place you get your loan officer registration or license from, mortgage broker license from. All these organizations, they only teach residential. Commercial is such a broad field. Like I mentioned earlier, there's like at least a dozen different type of niche industry.
Yep.
And they're a little bit different. They're more specialized when it comes to calculation and what you cannot do.
Yep.
So there's too many nuances. It's hard to train that. It took me nearly 3 years. And people in our industry, in my niche, they are very reluctant to train anybody.
Okay. Why is that?
I was working for the corporate bank. Well, I mean, come on. I mean, if you have the golden goose, why would you want to give it to anybody else?
Yeah.
Right?
They want to protect their income, right? Yeah. So that's why maybe like a small percentage, like 3% of, I heard, I saw some statistics, right? Like 3% approximately.
3%, I think in Canada is increased now because CMHC released some statistics. Less than 5% of all mortgage brokers are competent to do commercial financing.
Wow. Okay.
Why I like to use a 3% is like out of the 5, maybe 3% are confident. Competent and confident is different.
Yeah.
You can be competent riding a bike, but I am confident riding a bike without my hands.
Right.
There's a difference.
There's a big difference. Yeah. Yeah. I guess it's like saying the difference also between just going for a weekend paramedic course to learn like basic CPR versus like trying to learn how to do brain surgery and being confident at doing it without, I don't know that analogy lies.
Yeah, no, I think the analogy I like to use when it comes to doctors. Like, I help a lot of doctors, medical doctors. I said, and I compare to them. I said, hey, there's a lot of MD, there's a lot of physicians, a lot of medical family doctor, but how many of those can operate on a brain? Neurosurgeon.
Or do a bypass surgery like what happened to me, right?
Oh, heart surgery, triple bypass. Oh my God. Right.
Yeah. Crazy. Okay, question number 5. If you guys are enjoying this, let us know.
Much lower.
Yes. Okay, question number 5. So how long does a commercial deal typically take to close?
It really depends, but on average, a commercial deal can close as fast as a residential deal, but we get paid on the day it closes. Whereas you guys on the residential side might get paid later when the company gets paid and it trickles down. I'll send my courier to pick up my check or if they don't wire transfer, I just go straight there and pick it up. I pay somebody whatever $100 to go pick up a check for me.
Yes. And so when you say you get paid, right? Is the lender that's paying you? Is the borrower that's paying you? Like
the borrowers typically the borrowers pays us. Lenders don't pay on commercial side. I mean, it closed sometime. Commercial deals can close longer because we are not in a rush. There is no quick close. There's no such thing as a quick close in commercial. Because it due diligence require like 4 to 6 weeks. To get it done. So it takes longer time frame to get it done due to the fact that it's not because I get the loan approved in 24, 48 hours. But the bottleneck isn't us. The bottleneck is the other partners, appraisers,
CPAs,
lawyer. There's so many partners involved. We're talking about people who survey, people who do
environmental
inspection. Environmental appraisers. Lots of them. Quantity surveyor.
Yeah.
Architect, engineers, you name it.
Like you actually almost don't want to rush it because you want to make sure that
You cannot, yeah, there is
Yeah.
no, yeah, no. I mean, you want to make a lot of mistakes, rush these deals.
Right. So before we segue into, learning more about commercial financing, so like the one thing I've heard is the big difference, like, see, when you're doing residential, there's always like a sort of like a time limit, right? You've got to get all your information with a certain time limit, versus in commercial, it's almost better to take a little bit longer to get it done properly. Is that correct?
Yes, because due diligence means that you need time to do research on the property itself.
Yep.
On the history of that property, on the history or even the seller, maybe, do they have any other debts? Do they have other liens on the property? Is something
Right.
we don't know.
Yep.
Sometimes commercial, like for example, if they're operating a business out of there, out of that address that they're selling,
Yep.
and we're buying the business and we're buying the property.
Yeah.
So sometimes it's a business sale as well.
Mhm.
Like, what about the debt on the company? Do they have an outstanding debt?
Right.
Because why? Some company have 60, 90 days to pay.
Mhm. Yeah.
You bought within the 90 days. Who's going to end up paying that debt? The company. Who owns the company now? You do.
Yeah. So you bought the debt as well, like, right?
You bought the debt as well. Yeah. So that's why we need due diligence, right?
Right. All right, guys. Well, I hope you enjoyed this video. Click the link in the description below. We're giving away 2 tools. Okay. One is called the COI playbook, and the second is what's called the SBA SBL deal screener. It's a calculator that it's a proprietary calculator that he's used to help calculate DSCR, NOI. It's a really powerful, useful tool to start seeing whether a deal is feasible. And if you don't know how to use it and you want to come to our live workshop, or if you have any questions you'd like to ask Sua directly live instead of just typing in the comments, we put on a live workshop every single week, sometimes twice a week. Just make sure you register because they fill up really fast. And when they do, then you're on the waiting list for the second one. So, basically what you want to do is go into the link below, register, pick up those tools. They're absolutely complimentary to you. We'll see you in the next workshop. Bring your questions, bring your deals, and make sure to subscribe. Come and join us for the next video.
You bet.
Take care.